Let's be real for a second. When you hear the phrase, building long-term wealth, does it feel like something for other people? People who are already rich? You work hard, you try to save, but the stock market looks like a high-stakes casino, and you're pretty sure the house always wins. All you hear about are stocks, crypto, options. It's like a different language designed to confuse you. And that fear of making one wrong move and watching your hard-earned money vanish? That's not just in your head. It's real. But what if I told you there's an investment strategy that legendary investors like Warren Buffett don't just approve of, but actively recommend for pretty much everyone? A method so simple and powerful it's been called the Get Wealthy Slowly plan that actually works. Today, we're breaking down exactly what this strategy is, how you can use it to own a piece of the entire market and build real, lasting wealth, all while keeping your costs ridiculously low. This isn't about hitting a home run or finding some secret stock. This is about using a proven, time-tested playbook that has built fortunes. The problem: why just saving isn't enough? Honestly, the investing world feels complicated because, in a way, it's designed to be. There's an entire industry that profits from making you feel like you need a PhD in finance just to get started. They bombard you with jargon, P/E ratios, technical analysis, alpha, beta, hoping you'll get so overwhelmed that you either give up or pay them a massive fee to handle it for you. So what do most of us do? We fall back on what feels safe: saving. We tuck our money into a savings account where we can see it. But here's the tough pill to swallow. The money in your savings account is losing value every single day. This isn't a conspiracy. It's just economics. It's called inflation. In simple terms, if inflation is at 3%, that basket of groceries that cost you $100 last year will cost you $103 this year. Your dollar just doesn't stretch as far. Meanwhile, even a high-yield savings account is probably paying you 1% or 2%. If you're lucky, you're doing the math, right? You're still losing ground. You're, quite literally, getting poorer slowly. Doing nothing is the single riskiest financial decision you can make. It's a guaranteed loss over time. So the problem isn't just being scared of investing. It's the massive, definite cost of not investing. You need your money to work for you, to grow faster than inflation, so you can actually build a future for yourself. The solution: the world's simplest, most powerful investment. Okay, so if picking individual stocks feels like gambling and a savings account is a slow-motion train wreck, what's left? That brings us to the single most powerful investment strategy ever created for everyday people: index fund investing. And before you click away, don't let the name scare you. The concept is almost laughably simple. Picture this. You walk into a giant supermarket. You could spend the next 3 hours trying to find a single best apple in the whole place. You'd inspect every one for bruises, check its color, maybe even try to smell it. That's like trying to pick individual stocks. It's exhausting, stressful, and you could still go home with a mushy, disappointing apple. Or you could walk up to the manager and say, "I'd like to buy a tiny slice of everything in the store. The apples, the oranges, the milk, the bread, all of it, with one purchase." That, my friends, is an index fund. An index is just a list of stocks that represents a slice of the market. The most famous one is the S&P 500. It's just a list of the 500 biggest, most successful public companies in America. An S&P 500 index fund is a fund that just buys stock in all 500 of those companies for you. When you buy that one fund, you instantly become a part owner of Apple, Microsoft, Amazon, and hundreds of other companies you already know. With one click, you're betting on the entire U.S. economy. You're not trying to find the one winner. You're betting that, as a whole, the market will keep growing and innovating. That's why it's called passive investing. You're not picking stocks. You're just buying the whole haystack instead of looking for the needle. Why this is the ultimate beginner strategy. The reason financial titans like Warren Buffett champion this strategy isn't just its simplicity. It's because, for most of us, it's just plain better. Here's why. First, the costs are practically zero. Most investment funds are actively managed, which is a fancy way of saying a highly paid manager and their team are trying to beat the market. Their huge salaries and research costs get passed on to you as fees, often 1% or more of your money, every year. 1% doesn't sound like a lot, But over a few decades, that fee can eat up a third of your returns. Index funds, on the other hand, are run by computers that just follow a list. Because of that, their fees, called expense ratios, are absurdly low, often as low as 0.03%. On a $10,000 investment, that's the difference between paying $100 plus a year versus just $3. Keeping costs down is the secret weapon of smart investors. Second, you get instant diversification. Diversification is just the smart person way of saying, don't put all your eggs in one basket. If you go all in on one company and it goes belly up, you're toast. But when you own an S&P 500 index fund, you own 500 companies. If one of them has a disastrous year, it's just a tiny ripple in your portfolio. That built-in safety net is what lets you sleep at night. Third, and this is the kicker, it beats the experts. This is the part that blows people's minds. Study after study confirms that the vast majority of professional, high-fee fund managers fail to beat a simple, low-cost index fund over the long haul. Let me say that again. The people who are paid millions to beat the market can't beat the market. So why on earth would you try? Warren Buffett famously won $1 million 10-year bet that a boring S&P 500 index fund would crush a portfolio of hand-picked hedge funds. He won, easily. His advice for the money he's leaving to his wife? Put 90% of it in a low-cost S&P 500 index fund. If it's the right move for the Buffett family, it's the right move for us. Your step-by-step guide to getting started. All right, enough theory. Let's make this happen. How do you actually do this? It's way easier than setting up a new social media account, and you can start with whatever you've got. Step 1. Open an investment account. You need a place to buy and hold your funds. This is called a brokerage account. Think of it like a bank account, but for investments. Go with one of the big, reputable, low-cost names like Vanguard, Fidelity, or Charles Schwab. You can open an account online in about 15 minutes. You can open a standard brokerage account, or even better, a retirement account with tax advantages, like a Roth IRA. Step 2. Choose your index fund. Seriously, do not overthink this part. For 99% of beginners, it comes down to two fantastic options. An S&P 500 index fund gives you a piece of the 500 largest U.S. companies. Look for ticker symbols like VOO from Vanguard or FXAX from Fidelity. A total stock market index fund. This is even broader, including those 500 big companies plus thousands of smaller ones. It's like buying the entire U.S. stock market in a single click. The ticker is usually VTI, Vanguard, or FSKX, Fidelity. Which one is better? Honestly, just flip a coin. Their performance is nearly identical over the long run. VTI is slightly more diversified. VOO is filled with the most stable titans of industry. Pick one. You've already won. Step 3. Buy the fund and put it on autopilot. Once your account is open and funded, just search for the ticker symbol like VTI and hit buy. You decide the dollar amount, and boom. That's it. You're officially a stock market investor and a part owner of thousands of American companies. But here's the real magic: consistency. Set up automatic investments. Decide what you can afford, $1.20 a week, $200 a month, whatever it is, and have it automatically pulled from your bank and invested into your fund. This is called dollar cost averaging. It forces you to buy regularly, whether the market is up or down, taking all the emotion and guesswork out of the equation. Step 4. Be patient and do absolutely nothing. This is, without a doubt, the hardest part. The market will go up. It will go down. The news will scream about crashes. Your job is to ignore the noise. You're not a trader. You're a long-term investor. You're making a bet that over the next 10, 20, or 40 years, the market will be worth more than it is today. Historically, that has been the safest bet in modern finance. Time in the market always beats timing the market. If this finally made investing click for you, and you want more straightforward, no BS financial advice, do me a huge favor and hit that subscribe button and ring the bell. It costs you nothing, and it ensures you won't miss the next video. And now I want to hear from you. Drop a comment below and tell me, what is the single biggest fear or question you still have about investing? I read every single one. Building wealth isn't about some secret handshake or winning the lottery. For decades, the best strategy has been hiding in plain sight. Index fund investing lets you ride the growth of the entire market with rock-bottom costs and a powerful, built-in safety net. It's a strategy that rewards patience and consistency, not frantic clicking and stressful guesswork. You don't need to be an expert. You don't need to be rich. You just need to start. There's an old proverb that says, the best time to plant a tree was 20 years ago. The second best time is today. Your journey to financial freedom can start right now. You have the knowledge. You have the plan. Go plant your tree.